Hello, folks. Welcome back. So I'm going to talk a little bit about the seek and destroy market profile. And if this is a new topic for some of you, just know that when the market's uncertain or our analysis is likely to suggest that the market is consolidating or sloppy or kind of like summer trading, and specifically around the non-farm payroll week. Just so happens that this is where we're at. The market can tend to go sideways and take out both highs and lows, run to a significant level, and then reverse hard and go in opposing direction. Today we had that very thing unfold. So I want you to take a look at this line chart here and notice how all the swing highs and swing lows get taken out. Then there's a run up and then crashes. And we're going to go behind all of this idea and flesh out how the algorithm does similar to this. Now, you've recently watched me do trading the seek and destroy profile. So now I'm going to show you with another example here that the market will seek specific levels of liquidity and how we can anticipate that and study it and learn how to, majority of the time, avoid it. All right, so we're looking at the euro dollar. This is an hourly chart. And as a reminder real quick, this is the only thing we're going to be touching on today because the markets are sloppy. And tomorrow, which is Thursday, there will be some heavy news for GBP. So check your economic calendar on forexfactory.com. Look up GBP for tomorrow and you'll see the heavy news that's coming out for it. So euro dollar hourly chart. You can see how we've had a buy side liquidity pool swept and then a sell side liquidity pool attacked. So with these levels in mind, we're going to drop down to a lower time frame chart. All right, so here's the 15-minute time frame. Here is midnight New York time on the 4th of August, 2021. And we had a shallow consolidation, creating a short-term initial high of the day, right around the 3 o'clock in the morning hour, New York local time. Then repricing lower for the London session, creating the initial low of the day. But notice what it did. It swept the sell side liquidity first. Then rallied up through New York open, attacked the initial high of the day, buy side liquidity pool, then repriced to the buy side liquidity pool shown on that hourly chart. Then crashed all the way back down to take out the sell side liquidity pool, resting below the initial low of the day formed in London, and then consolidated going into the close. I'm going to drop down into a 5-minute chart here and flesh this out for you. We have 7 p.m. New York time, midnight New York time. On a 5-minute chart, you're going to look for the highest and lowest prices. And you'll also do this with the highest open or close or the lowest open or close price. So you're going to get two measurements. I'm going to save us a lot of time, but you do this on your own study. Do it on the bodies as well. I'm showing you on the highest of the wicks on both swing low and swing high. Now it's important that you do this on a 5-minute chart because the algorithm will do this on this time frame. Okay, it does not work on a 15-minute chart. It does not work on a 12-minute chart, a 3-minute chart, a 1-minute chart, an hourly chart. This will only work on a 5-minute chart. So it's calibrated to this time frame. The highest of the Asian range, which is the range between 7 p.m. and midnight, New York local time. This is the Asian range high, the Asian range low. Once you have this range, you can do a lot of studies with it and project them up and project them down in the form of standard deviation. The consolidation that starts after midnight sweeps initially the Asian range high right there. breaks, and one more time sweeps above it, sells off. So you're having a very small 5-minute optimal trade entry sweeping the Asian range high. So what you would do is draw that out in time, and you can see how they've worked it here, here, and then it reprices lower to attack that sell side liquidity pool on the hourly chart. That's that red line. It plunged below that, creating the initial low of the day. Rallied off of that through London lunch. It was quiet, and then right on schedule, 7 a.m. New York open kill zone. It reprices higher, sweeps down into a fair value gap, reprices on the ADP non-farm change that came out at 8:15 a.m. Eastern Standard Time. So you're having an economic driver drive price higher, and it attacks the initial high of the day formed in London. That buy side liquidity pool has been taken out, retraces, institutional order flow entry drill, rallies, and then sweeps the buy side liquidity pool here. If you look at the high of the day, go up 20 pips, it falls 1 pipette short from a perfect 20 pip sweep above the initial high of the day. Now every brokerage firm is going to have a slightly different high here. Some might be a little bit higher, some might be a little bit lower, some may be right on 20 pips. That's always the degree of separation between what's likely to be seen in our charts at a retail level and that of what the interbank actually prices at. So about 5 pips variance is normal. You're going to find that when I teach you the Asian range standard deviations and how to measure them out, you're going to get within 3 pips. That's usually the standard. So it's like a variance of 3 pips from what the actual high of the day is and what these levels will call. You might be a little bit over, a little bit under, and sometimes right at it. But 3 pips is as close as I can get you without doing things I'm not supposed to be doing. So if you look at the high here, this is the high of the day forming ahead of the ISM services PMI number for the dollar. So this was dollar-based, and this was dollar-based, both high-impact news events. So on this candle right here, that's the 10 o'clock candle, we swept the buy stops first, then came off a little bit, and then the algorithm aggressively reprices, attacking the sell side liquidity resting below the initial low of the day. Now, I want you to think about it from a narrative standpoint. The market rallies up ahead of the high impact news, the last high impact news for the dollar at 10 a.m. So it runs the stops first, knocking out anyone that was short overnight with London, really sweeping it up higher, taking out that hourly swing high, failing to get to the 119 big figure. Now, again, your live account might show it touching the 119 big figure, but that's not my argument here. It's the purge of the liquidity above this level on the hourly chart ahead of the ISM PMI number. The initial number here came out that was poor for dollar, sent price up. It swept the buy stops. Then they released data that was strong for dollar, and then you have this displacement on the downside attacking the sell side liquidity. So if we take this and go one step further, here is the standard deviations here. What I'm doing here is I'm using the Fibonacci trend tool, anchoring to the low, up to the high, back down in. You'll get this projected level here, 2.5. So this measurement comes to 1.18978. So we can put that level here and take the other level off. So we have this level and the old 60-minute or hourly high. You can see we swept above that here. But now I'm going to take you into swing trading ideas and how we can use that information. The swing low at A up to the high of the day at swing high B. These two reference points are the initial high and low of the day. When it breaks this high and it's rallying, how far can it go? Let's say you weren't paying attention to that hourly chart and you didn't notice that liquidity pool. It happens. I mean, you're developing. But you do have the standard deviation 2.5 level calling for this right here based on the Asian range. Let's see if we can get some confluence in agreement within 3 pips from this low to this high, and we'll just use the regular Fibonacci. So we're measuring the low up to the high, and make sure you're toggling on your settings negative 0.5. It's calling for 118.98 and 8. Okay, so that's what we're looking for on the Fibonacci. We're not using Fibonacci on the basis of the classic extension levels. I'm not teaching that because the algorithm doesn't care about that. You see so many people out there looking for the 0.88 level and all these other levels. That has nothing to do with what the algorithm's doing. All we're doing is looking for this range here to here and deviations above and below that are in increments of half of the range. This is 1, 2, 3 of 1/2 of this range. Okay, so 1/2 of this dealing range, high to low. This is 1, 2, 3. This is almost in agreement with this level here. So if we have that, we know that there's a likelihood that anywhere in here up to the big figure, 119 big figure, we could see it reach up for that. But now couple that with the initial daily high, 20 pips higher, lots of confluence in here. So look what's going on here. 118.97 and 8. 1 pip above that would be 118.98 and 8 pipettes. 2 pips above it would be 118.99 and 8 pipettes. And then we would go into, obviously, the 119 big figure. So within 3 pips, like I teach in the mentorship, you're going to learn about this, obviously, if you're in the 2021 group, when you get into model number 5 as a charter member. And you'll hear me talk about how in the teachings for the standard deviations on the flout, Asian range, and central bank dealers range, it gets within 3 pips of the daily high and low. But you have to have other things in agreement with it. You just can't say, well, I'm going to look at, a standard deviation of 2 or 3, and then that's enough for me. That's not how it works. You have to have some other things that lend to that idea, like we have here, 20 pips reaching up above the initial high of the day, going into a high impact news event. So it's running up, and you've seen me talk about this before in other teachings, where a liquidity pool that is being purged ahead of a high impact news event usually is them pricing in an extreme premium for them to run stops out and then aggressively go the other way. And that's what we're saying here. Now for the low of the day, we have the initial low of the day here, and you can see that price is 118.42 on 1 pipette. Now I want to talk to you a little bit about calibration. Now calibration is where you take what you receive in your retail feed, which is forex.com here. If this low comes in at 118.42 on 1 pipette, is it really 118.42? No. It's really 118.43 because it did not come down a full pip to get to 118.42. It failed to do that. So the round up to the nearest pip would be what? 118.43. That's what you have here, noted. 10 pips down below that price takes us here at 118.33 even. And it goes just below by a hair, and that's a 10 pip sweep there. So you're looking at how the market trades with these aggressive runs using the news. When it's in range trading, it's in summer doldrums, it's ahead of a big news event that's going to occur for GBP tomorrow. And then we have non-farm payroll as well. So there's lots of landmines, and that's what I mentioned ahead of time. Try to be very careful trading this week, because if you maybe got caught by this, maybe got hurt, and you don't want to tell me, This is seek and destroy. It's taking the liquidity on both sides of the marketplace, running up for one that's going to really pay out later on, which is the buy side liquidity here above that 60-minute chart high, and then attacked all of the individuals that went long here. So look what they did. They punished the shorts from London that made money here. They ran those out. Really ran out those individuals that were short back further, took their stops out before the nice crash here, attacking the individuals that went long. They weren't allowed to be profitable either. So when you look at this and understand that that 5-minute chart here is the same thing here, exactly what I teach. This is actually a teaching that I showed publicly on baby pips. But the original concept still holds true. But the thing that sets it up, which is the reason why I tell you the non-farm payroll protocol, we try to trade Monday up to Wednesday's New York Open. London closed on Wednesday of non-farm payroll week. We do not take any more trades because this is classic. You will typically see a non-farm payroll week give you a seek and destroy type event. FOMC week typically will have this type of event as well. So those weeks, there's the reason why I tell you to be very, very careful, because if you don't know what you're doing, you can very easily get caught up on the wrong side. And even if you're on the right side, it can come back and bite you. That's what seek and destroy. It's seeking liquidity to destroy both sides of the marketplace. So since it's sweeping both sides, one of two things can happen. Tomorrow, it could be a lackluster day and it does nothing, and no one's positioned to do anything. Or they clean both sides, and then I'm going to make an initial run tomorrow that will be really nice, that gets attacked for non-farm payroll Friday. So hopefully you got something out of this, and I'm stimulating your thought process and justifying why I tell you to stay out of the marketplace post New York Open on Wednesday on non-farm payroll weeks. Now, it happens to be delivered on a Wednesday this time, but it's because we're ahead of big news tomorrow, and we're in August, and it's non-farm payroll. So it's a tricky week. It's classic seek and destroy conditions, and now you know a little bit more about it. Until I talk to you tomorrow, be safe.